Good morning, FinMonkeys listeners. I'm Noah Mercer. We're kicking off the day with a sharp move in oil after the U.S. announced fresh sanctions on Iran's Hormuz Authority, and a tumble in equity futures as the renewed U.S.-Iran tension rattles the market. That set the tone for everything we'll be watching today, from energy to yields. First up, VT Markets reported that sanctions on Iran's Hormuz Authority are tightening oil supply expectations, nudging prices higher, and that feeds straight into higher gasoline costs and inflation pressure. Meanwhile, Yahoo Finance UK flagged a dip in Dow, S&P, and Nasdaq futures as the renewed US-Iran conflict drags on, a reminder that futures set the opening tone for portfolios and retirement accounts alike. So what's really framing the day? The oil price climb is the anchor. Tighter supply expectations mean higher energy costs, and that feeds into broader inflation concerns. On the equity side, the futures slide reflects the market's nervousness about geopolitical risk, keeping the Dow, S&P, and Nasdaq on a tentative footing. Together, they paint a picture of a market caught between rising commodity prices and heightened uncertainty, a mix that will shape the trading session ahead. Looking beyond the headline, the oil surge is already nudging U.S. Treasury yields higher, as CNBC highlighted, because inflation worries are creeping back into the bond market. At the same time, Cacto noted that gold is slipping, even as investors keep an eye on upcoming PCE data, a sign that safe haven demand is waning despite inflation fears. And with the latest inflation gauge ticking up in April, Yahoo Finance reminds us the Fed is likely to hold rates steady for now, keeping borrowing costs. That's the FinMonkeys morning brief for today. The next thing to watch is for further sanctions updates and upcoming PCE data for clues on inflation trajectory. Thanks for listening to FinMonkeys. We'll be back tomorrow with the next market setup.